Hello and welcome to the video. Today's lesson is on aggregate demand and aggregate supply, so let's get right into it. Definitions are really important. So, aggregate demand is defined as the amount of real output or goods and services that all buyers in the economy want to buy in a year at different price levels, ceteris paribus. There's an emphasis on all buyers here, in contrast to micro, which involves a single market. Remember that the components of aggregate demand are the same as for real GDP, C plus I plus G plus X minus M, or consumption, investment, government spending, and net exports. So here's a diagram which shows two aggregate demand curves, which look exactly like micro demand curves. Notice that on the y-axis you have price level instead of just price. So, there are three reasons for the negative causal relationship between price level and real GDP, which is why the aggregate demand curve is downward sloping. So firstly, we have the wealth effect. So if price level rises, the real value of wealth falls, and wealth isn't income, it's assets such as stocks, real estate or gold. So if price level rises, the real value of this falls, so people feel much poorer, and hence they cut back on their consumption spending, and this causes real GDP to fall. Hence we move up the aggregate demand curve. Next is the interest rate effect. If the price level rises, consumers and firms need more money to finance their transactions, and hence the demand curve for money shifts right, and this causes the price of money or the interest rate to rise. The cost of borrowing therefore rises, causing firms and households to cut back on spending which is financed by their borrowing, and hence consumption and investment falls, and so is real GDP. And finally is the international trade effect. If price level rises, exports are more expensive for foreigners, so the quantity of exports falls. Imports are cheaper for residents of the country, so the quantity of imports rises. Overall, the quantity of net exports falls, and the real GDP of the country falls. So these are the reasons why if price level rises, real GDP falls. But if price level fell, then real GDP would increase. Moving on to aggregate supply. Aggregate supply is the total amount of real output produced in a year in an economy at different price levels. So there are three different aggregate supply curves, but in today's video we're going to focus on short-run aggregate supply, which is a new classical concept. There are also the long-run aggregate supply, which is a new classical concept, and Keynesian aggregate supply, which is Keynesian. So, here is a diagram which shows the short-run aggregate supply curve. And in the short run, in macroeconomics, it's the time period where all prices of factors of production are constant. So, if the price level rises, profits are going to increase with profits are going to increase in the short run, because the costs of production are constant. So firms are inclined to produce more output, and hence this means that the aggregate supply curve is upward sloping. So the aggregate demand curve and the aggregate supply curves shift just like the micro demand and supply curves. So when aggregate demand increases, the curve shifts right. Real GDP and price level both increase. When aggregate demand decreases, the curve shifts left. Real GDP and price level both fall. So here we have two diagrams which show this. So, what causes a rightward shift of the demand curve? Well, to find this out, we have to look at what causes changes in the four components of aggregate demand. So, we're going to look at what increases these components, but it's the opposite for decreasing. So, what increases consumer spending? Well, if consumer confidence improves, that is, the confidence that consumers have about the state of the economy and their incomes, their wages, consumption is going to increase. And that's because if they think that the economy is going to do well, they'll expect their wages and incomes to increase, so they're going to spend more. If the interest rate falls, that means that the cost of borrowing falls, and so borrowing increases and consumption spending financed by borrowing increases, which increases AD. Also, returns on savings fall, which means consumers are less inclined to save and more inclined to consume. If taxes fall, disposable income or after-tax income is going to increase, which means that consumers have more money to spend. If household indebtedness falls, consumers have to make fewer monthly payments and therefore have more money left over for consumer spending. And finally, if wealth increases, such as an increase in stock market values or an increase in real estate values, people feel wealthier and hence will consume and spend more. The next component is business investment. So what causes business investment to increase? Business confidence is the confidence about the sales of a business, and if this improves, their businesses are more inclined to invest more. If interest rates fall, the cost of borrowing falls, and investment financed by borrowing increases. If business taxes fall, after-tax profits increases, which means businesses have more money to spend on investment. If there's less corporate indebtedness, firms don't have to pay back as much debt and therefore have more money to make investments. And if there are technology improvements, businesses might make investments to acquire these technologies. What causes net exports to increase? So, depreciation of a currency. For example, if the pound goes down in value compared to the dollar, British output will appear more cheap to Americans, so Americans will import more from Britain, so therefore Britain's exports rises. American output also appears more expensive to British consumers, so British imports fall, and therefore net exports rises. Trade protection are policies to limit imports in a country. If trade protection domestically increases, then imports will fall, so net exports falls. Also, if trade protection abroad decreases, then exports will increase and X minus M falls. Finally, if there's a rise in the national income of another country, they're going to import more. So if China had a rise in national income, they're going to import more from Britain. So therefore, the exports of Britain increases and net exports falls. The last component of aggregate demand is government spending. So governments increase their spending when they're implementing expansionary fiscal policy to stimulate aggregate demand, or interventionist supply side policy, but both of these directly influence aggregate demand. So, those are the reasons why aggregate demand will increase, but the opposite causes aggregate demand to decrease. So, for example, consumer confidence decreasing or interest rates increasing or appreciation will cause aggregate demand to fall, causing a leftward shift. Again, Aggregate supply shifts are the same as the micro supply curve shifts. So an increase in aggregate supply causes the curve to shift right, and real GDP rises but price level falls. And when the aggregate supply curve shifts left, real GDP falls but price level rises, and this is a phenomenon called stagflation. Finally, what are the causes of the rightward shifts in aggregate supply? So a fall in resource prices such as oil or wages causes a firm's cost of production to fall, and if this happens, firms will produce more because they'll get higher profits. Subsidies are payments made by the government to firms which lower costs of production. If subsidies increase, then firms' costs of production decrease, and hence they will produce more, and the aggregate supply curve shifts right. Taxes are treated as costs of production, so if taxes fall, the costs of production fall, and hence aggregate supply increases. Positive supply shocks, such as good weather, can increase agricultural output, which allows firms to produce more, and hence aggregate supply increases. Appreciation means that imported factors of production become cheaper, which means the cost of production decrease and supply increases. Again, it's the opposite for leftward shifts. So if there's an increase in cost of production, such as wage increases from minimum wage legislation or the bargaining power of labour unions, that's going to increase costs of production, causing firms to produce less and aggregate supply to fall. That's the end of the video. If you liked it, please like and subscribe and share this video with your friends. Thanks.